San Diego has found itself in an unusual position at the end of 2013, outperforming most of Southern California and the U.S. overall on rent growth. Welcome to Apartment Market Dynamics from MPF Research. I'm Jay Parsons with your San Diego update. San Diego is one of the nation's more steady, reliable markets. In good times, it doesn't post especially big revenue growth, but in bad times, it doesn't post especially bad losses. And we saw that during the past two cycles. San Diego wasn't hit quite as hard as its peers in Southern California, but coming out of the recession, we saw such big growth for the U.S. apartment sector, San Diego pretty much still held steady. But now we are starting to see some pretty nice momentum. Take a look at this chart comparing year-over-year rent change in San Diego to the U.S. overall since the middle of 2010. Both went positive on year-over-year change in Q3 of 2010. The U.S. overall shot up from there. San Diego held steady at 2.5% for much of that time. But just as the U.S. numbers have cooled down a little bit, San Diego has heated up. In each of the past two quarters, San Diego has outperformed the U.S. average. As of Q4, rent growth measured 3.6% in San Diego versus 2.9% in the U.S. overall. That was fueled primarily by strong growth in San Diego's middle market product. That 3.6% hike also put San Diego in the unusual position of ranking ahead of most of its peers in the SoCal region. San Diego tied with Orange County for the largest hike in Southern California for 2013 overall, well ahead of Riverside, San Bernardino at 3%, and Los Angeles, which saw rent growth slide to just 2.4%. Now, what's driving these recent hikes? Well, interestingly, San Diego is one of the few markets in the country that's actually seeing employment growth on par with the employment growth seen prior to the recession. In fact, in 2012, job growth actually hit a decade high, and in 2013, job growth was still quite strong, by local standards anyway, with 23 new hires on net. That amounts to an expansion rate of 1.8%, second in SoCal behind only Orange County. And furthermore, San Diego is back around pre-recession employment levels, and it's the first market in Southern California to reach that milestone. So given the solid economy and given good rent growth, you'd expect to see occupancy in good shape, and indeed it is. 96.4% as of Q4 13. That's a little below pre-recession norms for San Diego, but still quite healthy, and it's been around that level for most of the past 3 years. All good news, but there are two headwinds that could come into play for San Diego. Number one, while job growth has been good, the growth is generally coming in lower paying employment segments, so that could pose a challenge for rent growth going forward. In fact, that's the big reason why rent growth tends to be more limited here compared to other parts of Southern California. And then number two, construction is up to decade high levels. Now there's a caveat to that. San Diego just traditionally doesn't build a whole lot of new product, and so even though it's at a decade high, the overall numbers aren't all that significant. In fact, once all the units are built, that will expand the inventory base here by 1.9%, which is only 30 basis points above the U.S. average. So given all these factors, MPF Research expects occupancy to hold steady in 2014, assuming that job growth remains solid as expected, and rent growth should cool down just a bit, but not too much, and our models pin the number at 2.9% growth for the next year. And that wraps us up for San Diego. So until next time, for Apartment Market Dynamics and MPF Research, I'm Jay Parsons. Thank you for watching.
Want more? Go deeper with NPF Research's apartment market reports. From a national level, down to individual metros, to specific neighborhoods, NPF Research has been providing unparalleled apartment market intelligence to the multifamily industry for almost 5 decades. Learn more by contacting us at 877-284-4938 or visit www.npfresearch.com and click on Market Reports.